What's up, everybody? Guy Costin, founder and CEO of Dakota. Just wanted to tell you, we have just released a new podcast called Fundraising News. So those of you who are subscribers to Dakota Marketplace, you know that in the upper right-hand corner of our homepage is our fundraising news, where we roll out 6 new articles a day, all related to fundraising. As you know, tracking all of this information is very difficult. Well, we've tried to make it very convenient for you to be able to stay up to date on all fundraising news by releasing a 10-minute fundraising news podcast twice a week, simply going through the different news items hosted by Pat Ty and Conch Mua on our team. So where it can be found is in the App Store on Dakota Fundraising News, or you can go to Spotify or iTunes and you can find it in the podcast sections, where all you have to do is type in Dakota Rainmaker Podcast, and Fundraising News is located in between the interviews that we do with distribution leaders. Fundraising News is awesome. You can listen on your way to work. It's chock full of really useful information. So please listen. Have a great day. Hello, it's Guy Costin, founder of Dakota, and I want to talk about Rainmaker Live. It's a show that we go through everything that we've learned over the course of our lifetime, really, in sales and fundraising, and we share that. Think of it as best ideas, but there's a lot of myths out there that we basically unbundle, if you will. We demystify the things that you should be doing, we all should be doing to get leverage, and that's the theme. The theme is all about leverage. What can a salesperson do to get leverage? And there's a few key points that we're gonna go through that are really game-changing. So you don't wanna miss it. Please register below. Join us for another Rainmaker Live. You don't want to miss this episode. What is up, everybody? It's Guy Costin, founder and CEO of Dakota. Welcome to the latest edition of the Emerging Manager Growth Show. I'm joined by my colleague, Tim Dolan. Tim, thanks for joining.
Of course, thank you.
As always, we want to try to present information that's relevant to a fundraiser. And, you know, emerging managers have always been near and dear to our hearts. And hopefully we're always trying to drop a few kernels of nuggets, if you will, to help you in your fundraising efforts. And most importantly, helping you build your firm. So I'm joined by Tim. He's been on our fundraising team since 2011. Tim, we always like to open up with some good news around fundraising. What's happening? Obviously, our whole business since starting in 06, we raise capital for investment firms. We do it on an outsourced basis. We've done it for one firm for 18 years, another for 16 years, another for 13 years, another for 10, 2 private credit and private equity firms, most recent in the past 3 years. So 9-person sales team. We're active in the marketplace. Tim, let's talk about fundraising, especially for emerging managers. What's going on? What have you seen?
Absolutely. I would say first and foremost, the exciting part is people are back taking meetings in the office.
Definitely a trend we've seen.
Yes.
What's happening?
So
key takeaway. And by the way, what we're going to go through today is we're going to hit some of our topics, but this is going to be a slightly condensed version because we have an interview with Screen Door. Screen Door seeds emerging managers. This is an interview you don't want to miss. So we're going to go through quickly some good news from a fundraising perspective. We're going to go through consultants. Then we're also going to touch on some fundraising best ideas. Then we're going to kick it into a world-class interview that if you're an emerging manager, you absolutely don't want to miss this interview with Screen Door and their 3 partners. So Tim, I interrupted. My apologies, but let's talk fundraising.
Yeah. So like I was saying, people are in the office taking meetings, kind of getting back into the boardroom, which is exciting. Zoom is still happening. The lunches and the coffees are definitely still happening, but face-to-face meeting. What I would also say is a part of that is hitting the relationships you have, right? The people you know, but cold outreach as emerging managers, that's crucial, right? Hitting the accounts and contacts that buy what you sell. Right. There is that cold outreach. We do that every day.
Yeah. So the cold outreach is critical. But Tim, just so we can share some good news, you don't need to name names as much, but let's just talk about some of our managers, the wins we've seen, the action we've seen.
Yeah.
Right. Because there's a lot going on. Okay. For emerging managers, we have Spruce, our private credit strategy, amazing strategy, just did the first close. Dakota was able to do, a nice segment of that, and it's going to continue on.
Well, that's one I was going to highlight is Spruce. They do real estate debt, and they had their first close a couple weeks ago. oversubscribed on the first close. So we've got a $750 million target, and we're halfway there after the first close. So that gives us optimism, not only just for Spruce, but across all of our partners, that money is in motion, people are allocating. On the private side, a lot of it is where they're allocating in 2025. So we see a lot of the pacing efforts today. But on the long only side, I mean, we market concentrated active managers, mutual fund and separate accounts. I mean, fortunately, there's still allocations being made there, which is nice to see. Our value equity managers performing quite nicely as well. So,
And we all know, Tim, I mean, the key takeaway here that we always want to emphasize, and we would tell you if we didn't see through our efforts of cold outreach, of establishing new relationships, that if we weren't seeing allocations, we work almost exclusively with emerging managers. They might not be emerging after 18 years, if you will, but we've always started with that. Spruce is an emerging manager. It's a continuous cold outreach effort, but the juice is worth the squeeze, Tim, I guess is what we're saying. We're right here to tell you how hard it is, and cold outreach is hard, but it's the only way. There's not another way. You have to do the cold outreach. So if this is your first time listening to the Emerging Manager Growth Show, we're simply here to impart some knowledge. Before the interview, I'm going to go through some best practices that we adhere to on a daily basis. And so I guess, Tim, the takeaway from this is, in the past month, we just continuously see, we've built our pipeline. We continue to see more and more closings, whether it's for large cap growth, mid cap growth, private credit, private equity, even some individual deals. We're seeing a lot of lift. So, but that's because we're in the market aggressive every single day.
I mean, as Guy said, we market emerging managers, even though they have longer tenured, but interesting, unique ideas are always of the attractiveness of our buyers, right? They want interesting, unique ideas, and that's what all of you have on this call. So they're, in some part, they're kind of just waiting for you to call them, and it's on us to do that.
Yeah, and I think kind of one of the somewhat depressing things of super talented, we have so many talented managers that we come across that are on this call right now, is that it is the yeoman's work of booking those meetings via cold outreach, Tim.
Yeah.
Right. And it is tough. And we run across managers all the time, but it does pay off. But it does require those 15 to 20 to 25 emails a day focusing on a city. So, with that, Tim, we always highlight during our show one channel that we think that you should be thinking about. Today, we're going to do consultants. And Tim, we're going to send out, we have very detailed notes on the consultant channel that anybody who registered for this webinar will receive this, and I'm looking at them right now. Can you just go, Tim, and give about a 1-minute overview of the opportunity in the consultant channel, how to handicap it in terms of probabilities, why it's important, why it's kind of a project-based process where we're going to go through some names with you. You want to make sure you get in front of those names, introduce yourself, make sure you're in front of them.
Yep.
I don't want to steal your thunder, but I think this is we've given you, being very serious here, 1, 2, so it's 3 pages of detailed notes on the consultants, specific names. Tim's going to touch on them. They'll be in the call notes. You'll get it after the call. Recommend to the team, Tim, what you believe is the most sensible approach to go after the consultants for their emerging manager programs.
Yeah, absolutely. And we cover on other shows different channels that might be higher probability from near-term success, whether it's the RAs and family offices, but the consultants are definitely a must hit. It can't be your only focus, but it's a definitely must cover. And it's really broken down into kind of 3 main segments. It's the emerging manager consultants, it's the large kind of national global consultants, and then what is ever growing is the OCIO groups. So just getting into each of those subsets, the emerging manager consultants, which we've heard from exponents and Adam Chopin on the Dakota Live podcast and on the show many, many times. That's an example, right? Where they can be seed investor for your strategy early days. Addix is a good example. Legato, Bivium, Leading Edge, Stable. The one consideration with these programs, though, the emerging manager programs, is fees. They're likely to be heavily negotiated on the front end, but they can help really ramp up your AUM. They do allocate in size, but just want to manage expectation. The fee conversation is crucial with them.
So if you go back into past episodes, you can see in the show notes that we have RAs covered. If you go back and listen to any of our RIA episodes, we go through in detail. That should be your primary channel for an emerging manager. Family offices, less so. Here's what I'm going to tell you. You can cover them, okay? There's a little myth there, okay? Not only cover the large family offices, the smaller ones, mid-sized ones. It's a capital allocation issue. RAs are not only growing with the market, they're also growing with new clients. They're run as professional organizations for scale. They're always looking for new and interesting investment ideas. That's where you're going to get, in the first 2 years, your initial funding if you have a dedication to selling into that channel. The consultants, okay, need to be covered, but they need to be covered on a name-by-name basis, very systematically. We have all the information that exists. As Tim just said, you have emerging manager programs, you have OCIOs. You need to make sure they know who you are and what you do. That is the goal. You're probably not going to raise a lot of money there, but you can't neglect the channel because there is hope, okay? Yeah. Because they are looking for strategies like yours. And we see time and time again, emerging managers get hired, but these are longer term sales cycles. They should be done on a parallel track, multiple spinning plates, however you want to think about it. Cover the accounts in the show notes that we share with you. Over time, we've seen success, but remember, the largest RAs, especially in your geography, should be the ones that you're hitting on a consistent basis. Consultants are a great channel to hit, and we have all the details because, like I said, we could run through this, but it's 3 dense pages of information that we will send to you so you can review and make the sales calls to set up the meetings on your own.
Perfect.
Great. So before we dig into the interview with Screen Door, we do want to go through some fundraising best practices. And it's the most important thing about an emerging manager, Tim. We've done this for years. We do it every single day. It's called the Dakota way. It's part of what we do, is you have to figure out a way to do more with less. You have a limited budget, you've limited time, and you need to get to market quickly. And so as we walk through, Tim, let's just talk about city scheduling and emails, okay? It sounds logical. We always want to review it. We do it every single day. It is pedestrian. It does work. And I always find myself somewhat apologizing that this has to be the path forward, but we really don't have a choice. We've seen it work for 18 years on our fundraising business, for the past 6 years on our database business. Cold outreach using city scheduling. Turn it over to you to talk city scheduling and email.
Yeah, so this is a organizational tool, but also I think more importantly, it provides purpose to a salesperson, right? So the city scheduling, and you have a pool of accounts as an emerging manager, as we recommend the RAs, some family offices, but really the RA channel, right? There's a lot to cover across the country. So in Chicago alone, let's say there's close to 100, right? In one day, it's like that can be overwhelming. But if you just have a city 4 to 6 weeks out and you have a very tight email, which we'll get into, right? You wake up on Tuesday and that's your purpose.
Right.
I'm scheduling for Chicago. We hold to ourselves, and we recommend to you all to have at least 5 cities on the calendar at any given point in time. That gives you purpose, as well as that is a organizational mechanism to cover channels and certain accounts.
The more disciplined you are to this process of 5 cities with 9, 11, 1, 3, and 4:30 circled, the more success you're going to have. And you have to be very thoughtful about your email. So we'll run through, and as part of the show notes, we're going to have our email PDF, which is basically best practices for doing cold outreach. And it's subject line, meeting request, date and time, 1 sentence to 2 max, who you are and what you do and why someone should care. Like, why should they take the meeting? Then a clear call to action. And a clear call to action to say, can you meet November 6th at 3 p.m.?
I just want to emphasize that clear call to action, because we get a lot of emails sent to us. It's like, hey, I'm not getting any responses. A clear call to action to emphasize is, can you meet at 11 a.m. on December 6th? It is not, are you around the next couple weeks?
Yeah.
Right? Open-endedness does not work. Like, that is, I want to emphasize that because we get it sent, and I just want to make sure. So I have to get to that. No question.
I probably had, because I ask anybody, if you guys, anybody listening to this call can send me an email saying, hey, would you review my email? And I will. So please send it, gui@dakota.com, gui@dakota.com. I'll review it, send it back to you, and I will edit your 1 to 2 sentences with a clear call to action. No one's ever sent me an email that had a clear call to action to close out. No one's ever sent me an email saying, can you meet in Boston November 6th at 3 p.m.? I always have to edit that. So it's very important. It's why we spend the time here. It's why we care about it so much. We care about you. We love emerging managers. We want to make sure you guys have success. We're laying out the blueprint. To close, there's more best practices in the show notes, but Tim, let's talk about the quarterly webinar.
Yep.
And it's really important as an emerging manager that you take the time. We believe, this is advice, okay? This is downright advice. We'll also send you in the show notes a link to how to create a quarterly webinar. And it all has to do with preparing your presentation deck and telling the audience exactly what they want to hear, right? This is an opportunity to flex your muscles. And you always want to have a slide on who you are. Always want to have a slide on your investment philosophy and process, and then dig into the meat of the quarter, what happened during the quarter, and share information that gives insight into how you manage money effectively, and use either specific stock examples or private company examples that show people why they should be excited to invest with you. And Tim, talk about the brand building that the quarterly webinar does when you're not asking, if you will, to take a meeting, you're just supplying them insight.
I mean, this is one of the best leverage tools that you can do as an emerging manager for a number of reasons. One, as you build your client base, they want access to the portfolio managers on a quarterly basis. Doing the webinar, for the most part, eliminates the number of one-on-one calls, right? Because you use it as a client service tool. You're recapping who you are, what you do, and how you did in the quarter, and an outlook going forward. So that can serve as a client service tool. PMs love that, right?
And remember, anytime you're talking to a due diligence analyst and you send them your quarterly webinar, where they go through, you do it on Zoom, and you go through the slides, if they're going to take a meeting with you, due diligence analysts are analysts at heart. They're going to absolutely review it, right? And it's going to take, they're going to feel like they know you. They're going to take the first 20 minutes, 25 minutes off the table, then you can get into Q&A.
Yeah.
And it serves as, number one, building your brand. You do a recap of the call. So as it's the recorded version of the call on your website, you transcribe it. A lot of people just read through the transcription. And then you can also do an abstract. So one pager, this is what was covered on the call, some details. And then you can also send that out as an accompanying attachment in your emails as you're interacting with a due diligence analyst as you're booking meetings. So the quarterly webinar unquestionably is mandatory for brand building and success in fundraising efforts for everybody, but most importantly, emerging managers. In addition to the show notes, we're going to send you out our other fundraising best ideas, which include events and conferences, the power of the CRM, which is very, very important, and the tools that you can use to leverage, and also how, we're not going to get into it right now, but the things that you want to be doing in meetings. It's all in the show notes. And the only reason we're running through this is because we do want to get you to a spectacular interview with Screen Door if you are looking for seed capital, and it might be a firm that you've never heard of before. So with that, I'm going to introduce the team from Screen Door, which is Lisa Cawley, Jamie Rode, and Lane Johnson, all partners at Screen Door. And so here we go to kick it off with the interview, the team from Screen Door.
Lisa, Jamie, and Lane Johnson represent Screen Door, an investment platform that invests in new managers, driving the next wave of innovation and new perspectives in VC. They provide limited partners with access to highly competitive managers, driving alpha that would be challenging for them to otherwise identify, access, and underwrite. Screen Door uniquely integrates robust LP frameworks with the strategic expertise of accomplished GPs, enabling them to underwrite the non-obvious in their manager selection and support process. Screen Door is a strategic partner that offers not only returns-driven portfolio exposure, but also direct relationships for LPs' portfolios, so that through their tight-knit LP community, allocators have early visibility into the next generation of leading VC firms as they scale. Lisa Cawley leads the firm as the managing director. With a deep understanding of venture capital across various stages, sectors, geographies, and levels of firm sophistication, Lisa quickly recognized the unique challenges faced by both limited partners, LPs, and emerging general partners, GPs. She saw Screen Door as the missing puzzle piece for allocators and GPs that could help capitalize on the significant returns potential within the venture capital ecosystem. Prior to Screen Door, Lisa worked with a private multi-billion-dollar global investment firm where she was involved in all aspects of managing the firm's private market portfolio, including sourcing and manager due diligence, asset allocation and forecasting, and creating and implementing the firm's investment data tools and analytics. Lisa started her career at Ernst & Young, where she served on private equity, venture capital, and publicly traded CPG clients. Lisa earned an MBA and MSF from Loyola University, Maryland, and she obtained a BBA in accounting with a double minor in information systems and Spanish from Loyola University, Maryland. She is a CFA charter holder and holds a CPA. Jamie Rode is a partner at Screen Door. Previously, she spent 8.5 years at Virtus Investment Management, a Generation 7 through 10 single-family office, where she focused on emerging venture managers, private equity, and hedge fund investments, including sourcing and due diligence. During that time, she played a pivotal role in building an emerging manager early-stage fund portfolio, using a data-driven approach, investing in a significant number of funds that were often considered too small or uninvestable by conventional LP standards. She joined Virtus from Bloomberg, where she held roles in both equity research and credit analysis, grounding her in using data to drive investment decisions. Jamie is a CFA charter holder with a bachelor's degree in finance and marketing from Drexel University. Finally, Lane Johnson, who was unable to join us on the podcast, is also a partner at Screen Door. Prior to Screen Door, Lane was at the Teacher Retirement System of Texas, where she led the venture and growth equity manager selection. During her time there, she was involved in setting the venture capital fund strategy, including portfolio construction and new manager sourcing and diligence, as well as finding ways to increase the pension's exposure to emerging VC managers. Before Texas Retirement System, Lane was at Goldman Sachs in the external investing group, covering both established and emerging VC, growth equity, buyout, secondaries, and hedge funds. There, she helped lead the Launch with GS program, including sourcing, investing in, and building portfolios of diverse private equity managers, which was when she gained conviction in the high return opportunity in emerging VCs, bringing new perspectives to the venture ecosystem. Lane holds a BA in history from Yale University and currently serves on the St. David's Foundation Investment Committee. Lisa and Jamie, thank you for being here today. It really is a pleasure. We're looking forward to asking you about everything the Screen Door has been up to. Who is Screen Door? What are you looking to accomplish? We've talked a little bit about how the team works together, but ultimately, when you're sitting in front of a potential allocator, how do you describe yourself?
So Screen Door, we think of ourselves as an investment platform. We are investing in the new in venture because we believe that the new is always going to be a source of innovation and a source of competition that has the potential to fuel outsized venture-like returns. And so what we do is we consider ourselves an LP of GPs. So we're a team of allocators. So we all come from very different LP backgrounds, and we marry that up with GPs who have all built their own firms over time. So we're not only backing a manager because we believe in their ability to be an enduring firm over time, but we do that by integrating these GP advisors into our process, into our diligence process, into our post-investment support. And then it's actually our goal to help our LPs build relationships with them for the long run so that whether through us or down the line directly off of their own portfolio, they can build relationships and have that direct exposure over time.
Especially with Screen Door, it's a very much community-focused environment. And it's such a small, funny world because I met Lisa and realized there was significant overlap in both of the venture books that we were part of. And now that I'm at Screen Door, I work with Charles Hudson and Eva Ho constantly, yet I met them back in my prior life in 2016 when building out the venture early stage portfolio. And it's so funny to come full circle and realize that I was engaging with them, looking to make investments and using them to build out my venture network. Because in the beginning, as an allocator, I had to do so much market mapping just to identify what the opportunity set was. If I wanted to do pre-seed and seed, who were the players and how many managers did I need to do to build a steady state book? And so I leaned on them, and now I get to work with them, and they help on the sourcing. They help on the underwriting due diligence side, seeing them conduct reference calls with founders, seeing them stress test the managers. We can stress test from an allocator side, but with Screen Door, we have GPs that have been there, done that, stress test these fund 1, 2s, and 3s and say, okay, I had to deal with this. Have you even thought about this? How are you going to scale up your operations if this is your value add and now you want to do 3 times the amount of portfolio companies? So it's really, really interesting to see that. And then also have our LPs come to us and say, hey, I'm taking a look at this manager, not a fit for Screen Door, but but do you know them? And so then I can tap into a GP advisor and they can say, I have a long-standing relationship with this opportunity. I backed their startup 10 years ago. Now they're starting a new fund. I can tell you who they know. Are they truly a firm builder? Do they have the grit and endurance that is needed to be a successful firm builder?
Jamie, you've discussed the importance of investing in managers with unconventional backgrounds. So can you share how Screen Door evaluates the non-consensus qualities of potential GPs and why these qualities might lead to outsized returns?
When it comes to early stage venture, the outliers come out of the tails or the edges. And so Lisa would be like, what does that actually mean? You're talking in spreadsheets again. But it's really the right tail of the distribution that's driving that venture return. There's only 2% of startups that turn into the outliers. Only 20% of fund managers really make up the bulk of the venture return. So you have to be seeking out managers that are thinking and investing differently than it's been done historically. So at Screen Door, we really, really look at what has been your journey to today on a personal and professional level basis. Because I think, being at Screen Door, talking to Lisa, talking to Lane, part of our personal journeys to today have really shaped who we are. So I think it's really important to reflect on the personal side, not just the professional side, but understanding what that journey has been up until today. Also understanding, does your portfolio construction match that of your fund size and strategy? And is there a track record? That track record could be investing, or it could be being an early operator at 10 different startups. 4 of them failed miserably, which is a wonderful learning experience. 3 of them were pretty successful, and the rest were huge exits. So that is a track record because you've made decisions in your career to go work at these types of companies. Or has it been that you were an operator at eBay and PayPal and then Yelp, and it really gave you the experience to be that true value add on the cap table. And you have an angel track record of 15 deals. And so you can show that you can invest, you can write a check, but your experience as being an operator is really, really value add. And people are calling you to get on the cap table. And so it's really important to understand what those managers can access, because at the end of the day, and unfortunately, venture is such an asset class. And it's unfortunate that that's the way it is, but it's really important for us as allocators to be picking managers that can give us access to the top 1% of founders. So understanding what that journey has been, and it's important to be in the networks and geographies that are producing consistent outlier production, but also the ones where they're emerging. And so that's where emerging managers really come into play. They're identifying new sectors. They're identifying new opportunities. When you go back to 2012, Coinbase got its early stage funding. There was no blockchain fund. There was no Web3 really at the time. But to be able to identify that investment opportunity means you had to be thinking differently than the rest of the crowd that was probably still investing in enterprise SaaS focused, even though that's still a great sector. But to find the next generation of outliers, you need to find the next generation of GPs that are finding the next generation of founders. And so understanding the GP market fit is really, really important, but also understanding, given we're institutional allocators, are they building a firm? Are they going from an investor to a fund manager? Or are they just being a founder, magnet, and investor, which is level set required in this business, but you need to be a firm builder and you need to be an institutional fund manager to make it.
I think too, so often we find that if you're a multi-asset class allocator and you want to invest in new venture capital funds, you typically expect to be able to take your existing, I've backed, however many established managers, they're on fund 10 through 15. That's wonderful, because if they've made it that far, that obviously means that the returns potential has been persistent. You can't necessarily take a new manager who's raising some of their first institutional funds and take their track record and put it in the same model. Like, it doesn't work. And I think a lot of allocators, if they can't take the track record and put it in, the model that they're used to looking at venture and that lens that they've always looked at that part of the asset class with, to them, it doesn't pass go. And so when you're looking at these first institutional funds, like, you have to be able to think, instead of this Excel sheet, like, what am I really underwriting in this person? And I think we always come back to, like, somebody's greatest asset is actually their time, not necessarily their capital. Because capital will always be fleeting. It will come and go. Hopefully it will come more than it will go. But your time, it's the only thing that we all have the same of, and you never, ever, ever get it back. And so we think a lot about how did somebody vote with their time? Where did they spend their attention as they were building that? And I consider that absolutely part of somebody's track record, because to me, it's like you're voting with your feet. Like, if you can't vote with your dollars, then vote with your feet. And I actually find that even more compelling.
But it comes down to the decision, I think, that was made with voting with your feet, not the outcome, which is something that Annie Duke taught me is really important to understand the structure and process you implemented when making that decision. And that's something we focus on when looking at these managers, because if you're basing it off outcomes, you're going to be waiting 10, 15 years at this point to make that decision. And then that's just one fund. So it's really important when chatting with these managers, and this goes back to stress testing them. Do you have an investment framework? Do you have a structured investment framework that's going to help you build that enduring firm, help you achieve superior venture returns? Do you have a framework that will survive multiple market cycles, since we're signing up for a 15-year marriage and you're investing for an exit 10 years from now? So it's really important to stress test those, decisions, but not judge someone based totally on the outcome.
And this is where Lane comes in, and I think is just so powerful, but because she's building those conversations and having just like next level depth, not hitting a checklist of questions, like truly learning about the person to say, what is this person's background? Like, what new perspectives are they actually bringing that are going to be attractive to the best founders out there? So it rounds out our process in a pretty robust way.
What's the response been like from the emerging managers? So they're getting access to this advisor network. It's obviously very differentiated, but when they get that call, what's that response been like? So how have you seen that interaction actually play?
I think that most of the prospective GPs, when we're going through our diligence process, they probably are the most excited about a lot of the conversations that they're having. And this is just in diligence. This is managers that we haven't come to an investment decision on them yet. And so what we end up doing in our diligence is we bring in very strategically too, in terms of how we make that match work, but we bring them into the process. And I think, as any allocator knows, an LP to GP conversation or an LP to founder conversation has just such a different dynamic than two GPs sitting and talking to one another. You have a different set of topics that you probably focus on because you have a different lens on the venture ecosystem. And so I think most, I would have to say, probably walk away from that conversation learning something, both the GP advisor and the prospective manager, but then they also feel like they can take that and actually take that as tangible feedback that they can then either build into their next pitch, take in as feedback for how they're building their firm, how they're building their team, how they're messaging themselves to the broader market. And so it's really, I always say the sky's the limit. There's no question that is off limits, and there's no question that probably, is too detailed or, too silly or trivial sounding for them to ask. Because at the end of the day, any new manager, if you have that question, you're not the first and you won't be the last. And so what we want to do is make sure that we're helping these managers with these guardrails. But at the end of the day, there's so much uncertainty and so much that if you're only focused on investing, you just don't know around the other aspects of building the business. And so that's where we can help give additional perspective and advice. I think when you see a lot of different structures out there in the market, everybody has a slide of advisors. Like I almost wish we could call them something other than GP advisors, but that is like factually and definitionally what they are doing. Everybody has their slide of advisors, and they may make, a 5-minute phone call every year, or they may just be a logo or a picture on a page. That's not what Screen Door is. So Screen Door, our GP advisors, are the DNA of the firm. They are, part of our founding story, and is so critical because that's why we think of ourselves as an LP of GPs, where we are a limited partner. We will make LP commitments into new managers on behalf of our investors. But post-investment, what we end up doing is bringing those GP advisors into the portfolio to help navigate through managing, the extremely long duration nature of a venture fund. So we pair 2 GP advisors with every manager in our portfolio. And that's their go-to person, or two people, I should say, for both tactical questions that come up probably daily, but also more strategic questions. I want to bring in a new partner, and I'm thinking about that over the arc of a multiple fund cycle. I am thinking about, how I might position platform opportunities for my portfolio companies. How should I be thinking about augmenting that in my work? And so it's really powerful, because otherwise, in the absence of that, what I like to always think about is that a new manager without that support has a much tighter funnel of which they're picking and making decisions off of.
There hasn't been a firm to date that makes investment decisions not just based off of experienced allocators, but also experienced GPs that have been through market cycles and have seen what success is and failure, and dealt with the challenges that you're ultimately going to incur when it comes to building a firm. So to me, that's what's really unique about Screen Door is it's not just allocators making the decision, it's allocators that are augmented with experienced GPs. So I just think it brings very diverse perspectives and fun conversations and deal meetings where there may be some dissent there, but that's healthy. And that's the way you make decisions that lead to success, is when there is conversation and there is disagreements and you have those debates, because personally, I don't think the best outcomes will be based off 100% consensus.
Can we talk a little bit about sourcing and sourcing managers? And we have a lot of our audience who are GPs themselves, and they're interested in how to access Screen Door. What you're looking for, we've touched on, but when you think about sourcing these underlying relationships, what does that process look like?
There are three main ways that we come across new managers. The first is just by way of us being LPs for however
A long time.
So through our LP networks, we're always trying to find folks, and we want managers to be able to find us too. I think it's always chronically so difficult to find the LPs that are spending time in emerging managers. So we're not shy about that. That's really important. The second thing, and this is again, I think a difference maker, is this is where the GP advisors come in. They're out there in the market. They're active investors. They know who's involved in deals, and they may know who is considering building the next firm and who's considering building a new brand. And so they send those managers to us so that we can have a conversation with them and start to hear their stories. And then the final way is we actually, in the spirit of wanting to be in touch with people, we don't want people to need a warm introduction to talk with us and have to spend the time and energy to go and track down and triage. And so we have a open website submission where GPs can go in and submit, share their information with us, share what they're building. And then that way that can be a catalyst for a conversation with us.
I'd say that GP submission form I love because we are able to track data on it. And so that really helps when it comes to the decision on an intro call, because, as Lisa would say, time is really, really important, and it's your most valuable resource. As we all know, pre-seed, seed, early Series A provides the most opportunities to compound capital and provide a potential great multiple return. And so that's where Screen Door plays. The second piece is sectors. I can control what sector I invest in or what sector I don't invest in. When it comes to venture, the outliers create brand new sectors. So for us, we really want to be focusing on managers that are giving us broad enough coverage of all the sectors that exist today, but also all the sectors that exist tomorrow. So sometimes that may mean a sector specialist because I don't have coverage of that particular area. But if we do go sector specialist, it's really important that that sector has the potential to produce venture-like outcomes because we are in it for the winners. The third piece is geography. Does that geography have the venture network, the venture mindset? I think it's so interesting, having been in the venture space for a while and working with these GPs advisors, which I don't want to date them, but they've been here a very long time and can say there's a certain mindset that you need to have where you can't be afraid of risk. And I think the New York geography has started to really emerge as an outlier producing ecosystem, but 10 years ago, it didn't have the venture mindset. It had more of a financial, publicly traded mindset, which doesn't lend itself to producing venture-like outcomes, because in venture, 98% of the startups are not winners. That means 2% are successful. So you need to have a proper mindset. And so I think understanding geographies Can they produce venture outcomes? Do they have the venture talent? Networks, do they have the venture mindset? Do they have the talent? And then lastly, does this GP, and yes, it's through a deck or through a paragraph that we give them to tell us why they're the best and what their experience has been, give us the indication that they have the right to be that founder magnet and the best at sourcing, selecting, and winning for their strategy. So that's really the key things that we're looking for when the top of funnel comes in to make that decision on where to spend my time.
Data, what did I tell you?
How do you define success for Screen Door in the future?
Returns driven. We are out there finding emerging managers that are building firms and producing venture returns. I would say for myself, especially coming from an organization where I had helped revamp the asset allocation, investing in public markets, buyout, and venture, looking to prior CIOs who had done this before and really changed the world. For me, when it comes to Screen Door, there's so much friction and complexity when it comes to investing in emerging managers. I want to reduce that. I actually want to get rid of all of that. And that aligns so much when chatting with the team here. And so what David Swenson did for the asset allocation industry, we want to do here at Screen Door. We want to make it so our investors find it so much easier to invest in this space. And so it's not as much of an access game. I think relationships and networks are always going to be integral to investing in innovation, but finding a way to make these investments should be easier. And that's what we're going to do here at Screen Door.
Yeah, the number one far and away is always to have the chance to build a benchmark beating portfolio and drive returns for our investors. They all have stakeholders, and we think deeply, not just about the LP and the line item name on a page, but the people and the organizations and the communities that will benefit from that capital. That is always at the forefront of my mind in terms of when we're making our decisions on the portfolio and how we build this firm over time. I think in terms of the immediate ecosystem and industry, I always come back to this feeling of you don't want to be just a limited partner in the industry. You want to just be a partner. And that, I think, is something that is I've learned that throughout my career and is so deep in my core that whether it's to our GPs, success to me is that they look at Screen Door as just an exceptional LP and an exceptional partner. I think I would hope the same from our investors, that they look at us as a strategic extension of their team and as a real partner that they have a relationship with and can trust and can build their own portfolios around. And success in a very specific way for us is that we want our LPs to invest in the subsequent funds of our managers when, they're either sized in the right way, it's maybe the right fund size, or when it perhaps hits the right fund number. Some LPs are restricted in terms of it must be a fund 5 in order for them to invest directly in that manager regardless of fund size. So all of those things I think are paramount to how we think about success. It's returns that benefit the community. It's being a good partner to our GPs. It's being a good partner to the allocators that we work with. And those are all pretty symbiotic goals.
Thank you so much for being here today. It was really an insightful conversation. We learned a lot about Screen Door. We learned a lot about your approach. Congratulations on all your success. And we wish you nothing but good luck going forward. So thank you for being here today.
What a great interview with the team from Screen Door, right? Great insights. If you're looking for seed capital, we'll share the contact information. Unbelievable firm. Great opportunities to grow your firm with a partner like Screen Door.
I mean, that's some real money they're putting to work next year. I think $200 to $250 million. So for a lot of us, that can really move the needle. So hopefully you all enjoyed the interview.
Yeah, and so just another prospect for you to reach out to. And with that, Tim, as we're thinking about what's going on right now, money is in motion. I just can't emphasize that enough. If you want to win as an emerging manager, you have to be out there doing your cold outreach, booking the meetings. Obviously, you can leverage Dakota Marketplace, our institutional investor database and intermediary database to be booking those meetings. If you don't know anything about Dakota Marketplace, simply go to dakota.com, check it out, sign up for a demo. We'll walk you through everything. It's used by over 5,000 fundraisers, over 1,150 investment firms. Cold outreach is the only path to go. Do your quarterly webinar. We'll attach all the show notes. And like I said, good stuff is happening in the market. Okay, good stuff is happening. You just have to be out there booking meetings against qualified buyers is the biggest takeaway. So Tim, can't thank you enough for joining me again on the Emerging Manager Growth Show. Our next episode will be episode 26, December 10 at 1 p.m. Eastern Time. Thanks so much for joining. Can't wait to see you on the next Emerging Manager Growth Show. Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.